You've probably heard of initial public offerings, or IPOs, but what about SPACs? These are special purpose acquisition companies, and they are a twist on a traditional IPO. SPACs are formed solely to raise money through an IPO to buy another existing company. Also known as blank check companies, SPACs have existed since the 1990s. They've recently gained popularity as a way for big-name companies, like Virgin Galactic, for example, to go public. Why are SPACs so popular? A big part of their appeal is that they're often easier and faster than traditional IPOs, offering private companies an alternative way to go public. The Securities and Exchange Commission requires companies filing for an IPO to provide in-depth paperwork. Those documents include a prospectus that delves deeply into the company's financial and operational data. SEC filings are made available to the public before an IPO, and the process often takes 6 to 9 months before shares are offered to the public. A SPAC IPO, however, doesn't require the same level of historical data or operational information. As a result, the IPO process with a SPAC can take just a few months to complete. Once the SPAC has gone public, investors can buy shares just as they would in any other publicly traded company. The money raised during the IPO is put in an interest-bearing trust account and can be used only to acquire another company. What if the acquisition doesn't happen? No harm, no foul. The SPAC is dissolved and the funds raised in the IPO are returned to investors.